Hello, my name is AC Clinton and I am the Marketing Director and Senior Loan Consultant for your home loan partners of Pan American Mortgage LLC. And once again, I simply want to just begin by saying thank you. Thank you for considering us to be your home loan partners as you venture down the path to home ownership and or purchasing your new home. Today, we're going to be talking about capital gain exclusion. All right, so what is capital gain? Well, according to Investopedia, a capital gain is an increase in value of a capital asset. So what's a capital asset? A capital asset is any investment that increases in value or appreciates in value. So whether it's a piece of real estate, whether it's a stock, whether it's a painting, whether it's an antique, whether it's gold or silver, any investment vehicle that increases in value or appreciates is considered a capital asset. So back to our definition of capital gain. So capital gain is an increase in value of any capital asset that gives it a higher worth than the purchase price. A capital gain is only realized once the asset is actually sold. Now, the gain can be a short-term gain, which is an asset that has been held for less than a year and sold, or it could be a long-term gain, which is an asset that has been held for more than a year and sold, and the income that's produced as a result of the sale must be claimed on the individual or corporate entity's income taxes. Now, in general, a long-term capital gain is usually taxed at a lower rate. On the same lines, a capital loss is incurred when there is a decrease in the capital value compared to the asset's purchase price. Perfect example would be the stock market. Those people that had invested in the stock market had invested in a capital asset with the expectation that that capital asset will increase in value or appreciate. And when the market crashed, majority of those capital assets decreased in value. Therefore, the individuals that had invested in those particular vehicles had a capital loss. Hope that makes sense for you. Now, let's apply that to real estate and home purchase. So, according to IRS, anytime a general homeowner is selling a primary residence that they've lived in for a total of at least 2 years during a 5-year period, and that 5-year period ends on the date of the sale, and the gain is $250,000, $500,000 if filing jointly, or less. So if you own a property and you've lived in that property for at least 2 years, and you decide to sell that property and you end up selling it for more than what you purchased it for, therefore you have a capital gain. You do not have to report that income on your taxes, providing that it's $250,000 or $500,000 if you're filing your taxes jointly, or less. You don't have to report it, period. Now, as of January 1st, 2009, the government came back and they added a new rule to the capital gain exclusion. Homeowners that converted second homes or investment properties into primary residence, there's a different formula that they must use when considering the capital gain exclusion. Now, the new rule is based on the total usage of the home as a prior residence compared to the total length of the ownership. So what does the formula look like? Profits made from the sale of the home, right? So whatever the capital gain is, because that's the profit from the sale of the home, times the number of days the home was converted to the primary resident, divided by the number of days that the home was owned. So let's look at an example. If a homeowner lived in an investment property, a property that was initially purchased as an investment property but later converted into a primary residence for the last 2 years, and he purchased that property 4 years ago for $100,000, and in 2009 sold that property for $250,000. Therefore, there was a capital gain of $150,000. What percentage of the capital gain was tax-free? So if we did the formula, $150,000 times 2 the number of years that he lived in the house, divided by 4, the number of years that he owned the house, we're going to get $75,000. So therefore, 50% of that gain is tax-free, and the other 50%, he is entitled to pay taxes, capital gains tax, which is normally about 15% to IRS when he files his taxes for 2009. Now, why is this important? Well, one of the things that the capital gain exclusion does for homeowners is it gives them an opportunity to start building wealth. Purchase a distressed property, rehab the property, you create instant equity, and you sell it in 2 years. Now do this 3 times and let's see what those numbers look like. So you buy the first property the first year. Say you purchase a property for $50,000, you put in $50,000 in rehab. You turn around and sell it in 2 years for $150,000. Therefore, you have a capital gain, tax-free, because you lived in it for 2 years, of $50,000. You purchase a new property, you do the exact same thing. You turn around and you sell it for $200,000, therefore yielding a capital gain, tax-free, of $100,000. Another 2 years, you buy another property, same concept. This time you sell it for $250,000, yielding a capital gain of $150,000. Now, over that 6-year period of time, you would have generated $300,000. So, if you were to take that $300,000 in each of the years that you got the gain, started to invest that money over a 15-year period of time, so 15 years later, you will have well over $800,000. 15 years, $800,000. If used properly, the capital gains exclusion benefit for homeowners can definitely be a way to generate wealth. The goal is you have to buy right and sell right. Absolutely. Well, we hope that information was useful to you. Should you have any questions or concerns, please do not hesitate to give us a call at 877-588-6956 or email us at loans@yourhomeloanpartners.com and visit our website at www.yourhomeloanpartners.com. Until next time, see ya.